Good morning and welcome to the Investors Management Group second quarter 2020 asset management webcast for Seasons at Umstead. We appreciate you joining with us today. Our webcast for second quarter will present an overview of your investment with us over the most recent quarter. Today we'll discuss the operating fundamentals of Seasons in a review of reserves, income collections, expenses, and performance to budget, as well as talk about unique challenges and opportunities we're facing during the pandemic. We appreciate the confidence you place in IMG as your asset manager, and we hope that today's webcast delivers useful detail and context to understanding your multifamily investment. The hosts of today's webcast are Michelle Rivnak, Managing Director of Asset Management, and myself, Dave Nicholson, Investor Relations Manager. I'll remind everyone of a few features for our webcast. First, all the participants will be in listen-only mode to allow for clear audio. For those joining through the web, I'll encourage you to submit questions through the live chat pane. You can click the chat bubble and send your message to either the organizer or to everyone. For those not on the web, feel free to send questions to investor.relations@imgre.com. I'll collect questions during the presentation, and we'll address those during the question and answer segment at the end of the call. With that introduction, I'll turn it over to Michelle to review property operations.
Thank you, Dave, and good morning. Thank you for joining us. Here we're going to start with our property reserves for Seasons, and we have this broken out into two separate categories. So you can see here that our operating account has a balance of $349,000, and our capital expenditure reserve has a balance of $717,000, which combines for a total owner reserve of $1,066,000. We do have a replacement reserve controlled by the lender. That account balance is $265,000, and a capital reserve account at $978,000. There is a combined account for our tax, insurance, and rate cap escrow, and the balance of that account is $258,000. Combined for lender-controlled funds, we have $1,502,000, and then completely together for our total reserves, we have $2,569,000. So we are very comfortable with our funds in the bank for Seasons, and I would like to share with you our collection story, which is also a very good situation. So as you know, we've been tracking our rents on a daily basis since we've gotten into this COVID environment. And if you've tuned in, you've seen our information month over month. So thought it would be great for you to see the trend. So I'll take this slide a little bit from bottom to top. In April, you can see that we billed $287,000 in rents, and we collected $284,000, so 99%. May, we collected 100% of our rents billed. June, 100% of our rents billed. So the demographic here at Seasons is very strong. We've never really had any issues with bad debt or things like that, but you're seeing that even in this pandemic, they are very able to weather the storm. Our other income is hovering right around the $24,000, $25,000. It is a little lower than previous months due to not being able to bill late fees and things like that, but right on track and still very steady. So that gives you kind of what's coming in the front door, and it's a good story with Seasons. And from there, I'll take you through our budget review, kind of year to date, what we've done, and then what we're looking at for July through December. And if you have been tuning in with us for our previous webcast, we've gone through kind of detailed reforecast for you. This is a little bit more of a condensed version, but I will walk you through some of these numbers. If we look at income first, you're seeing not a real huge problem with bad debt here, but we did run into some vacancy. Now, as rates are dropping, some of our residents are moving out to pursue purchasing homes. So that left a little bit of vacancy, especially in the 3-bedroom units, the larger ones. So you'll see we've got our total potential rent trending down slightly by about $38,000. We haven't been able to push the market rents specifically on those larger units. And we haven't really been able to increase the renewal rates to maintain that occupancy. So you're seeing that there. And then other income, again, termination fees, late fees, and things like that. We're not able to charge those until the eviction bans lift. So as it kind of all settles out through the end of the year, we're projecting to come in about 3.4% under our budget expectations, or about $123,000 in income. Now, when it comes to expenses, we're expecting to be offset by $121,000, but in savings. So really, when it comes right down to it, our NOI is right on target. It's about $1,000 off of what we expected our budget. So we are really weathering the storm here. Now, when it comes to debt service, we're seeing a significant savings with the rate drop. So that looks to be about $344,000 as we're reforecasting the rate to stay about the same through the end of the year. So that puts our net about $345,000 ahead of the schedule. So very positive news for season. So that information is kind of high level. If you did want to dive into the details of the reforecast, that information will be available for you in your investor portal. The next bit of information we'll cover is the key metrics, but for that, I will send it back over to Dave.
Thanks, Michelle. So with this key metrics recap, what we're doing here is combining some of the data that Michelle's talked about and bringing it to a high level just to see what the collections figures, the occupancy figures mean when it comes down to the distributions to the owners, which is a key piece of this investment and any investment. So if we start here at the top, we look at the occupancy trend for Q2, and we can say it's really stable, about 95 in April, May, and dropped a little bit in June. And that, of course, plays into our collections. So in the collections, these figures for April, May, and June, these come directly from the slide prior, and we can see that when collections are high and our capture rate is high, as it's been, collections figures are right there at about $307,000, $305,000 per month, and then dropped a little bit to June to about $298,000. Now, affecting us here is our debt service. We're really receiving benefits with our debt service.
We may have lost Dave, so I can just jump in here. So our debt service, you can see from April was at $68,000, then in May to $54,000, and then in June to $48,719 with actual numbers. So very positive environment. We have distributions. The monthly distributions resumed in June, and the current annualized rate for that is 6% for cash on cash. We're constantly reviewing our distributions to understand the rates and the kind of environment that we're going through at this time. So we'll be reviewing that. If anything changes with the distribution rate, we would certainly be in contact with you. But for right now, we're comfortable and confident with that 6% cash on cash. The next bit of information to go over is really just headwinds and tailwinds in our national news. The eviction moratorium for renters in housing with federally backed mortgages, which is about a third of American renters, that expired on July 25th. Now, landlords are still required to give a 30-day notice for eviction, but we're moving forward with that. Not a big impact here at Seasons, but there are just a few that we'll have to go through and try that process with. There's the national news here with the expanded federal unemployment benefits are looking to expire on July 31st. These last payments are going out around July 25th or 26th, depending on the state. There's a lot of debate back and forth in the House and Senate. There's proposals for the CARES 2 Act and then the HEALS Act. So the items there include stimulus checks to households, the limits on the federal unemployment benefits, and the eviction moratoriums. So there's currently the $600 in federally backed funds that are coming out. They're negotiating that, whether that goes away, whether that gets reduced to about $200. They're kind of looking at a system where they can set it up to be about 70% of the income. So we'll see more to come on that. We're definitely following along there. And then let's see if we've got a little bit of, for our next slide, we've got some reminders on the investor portal. I don't know if we have Dave back yet. If not.
Yeah, I came back. Hey, Michelle.
There you are.
Thanks.
There you are. I'll go ahead and hand it back over to you.
So good coverage of the federal coverage there. So if we get down to the state level, North Carolina has been similar to some other states in the country, and Raleigh similar to some other cities with the second spike in coronavirus cases and hospitalizations. So here, the city was in phase 2 of reopening with the recurrence of the virus and the second spike. That phase 2 reopening has been extended an additional 3 weeks, and that goes out to early August. In spite of that, Raleigh as a market has been pretty stable and pretty well operational in terms of unemployment. It hasn't been impacted as hard as a lot of other cities across the country. Here, one statistic is with the rent growth in 2020. Rent growth has been slightly positive, and that's a little bit better than average if you're looking at cities across the country. Definitely going into Q2 and Q3 2020, the rent growth is way down from 2019 when rent growth was between 4 and 5% per year. What that means for our property here, really the biggest tailwind that we're benefiting from is the attractive debt environment. If we're looking at just the debt expense savings from March, the last month of Q1, to June, the last month of Q2, the debt service expense was down about $35,000. So every month that we have our LIBOR index down here where it's been in the 18 to 20 basis point range, that's a month that we really benefit with a lot of debt expense savings and benefit with the cash flow to the investors. Key to maintaining great operations here the rest of the year, really maintaining the high occupancy. The collection rates at Seasons have been probably the best of any property in our portfolio, and we'd anticipate that these residents are a lot more insulated from the economic shocks than some others. And so as long as that continues and we can maintain great occupancy and a great profile, we'd anticipate those collection rates stay high and that we continue to post great income numbers. So if we move to the next slide, just want to remind you on a couple of the recent postings at the investor portal. First is the June monthly operating statements have been posted. That's the place to go if you'd like to get into more detail about any of the figures that we presented here and look past month by month over the second quarter. Also, today's presentation will be posted in the portal within a few days, and those are both accessible at your Documents tab. Also, let me give a quick update on our current investment offering, Apex Apartments. That's located in San Antonio, and at this point, we're nearing full subscription. Member investments are accepted on a first-come basis, and at your investor portal, we've set up an electronic subscription process where you can go in and sign documents and process the investment that way. We're really excited about Apex. The occupancy and collections have been very strong, and also really pleased to be into the San Antonio market and the Texas market to give our clients another piece of diversification. So if you're interested in any more information on Apex, feel free to contact me or to contact Carlin to discuss the offering in more detail. Well, that'll conclude our prepared presentation and lead us into the question and answer segment of the call. If you'd like to submit a question, you can do that in the chat pane, or you can email to me at investor.relations@imgre.com. So we've received a few questions so far, and it's not too late to send them if you've got anything in mind. So let me send this first question to Michelle. Michelle, what steps are we taking to mitigate against increasing vacancy rates?
Sure. So we are staying on top of the market, and I think that's a key part of it. So we're researching our comps. We're making sure that our pricing is very competitive, manage to occupancy in this environment. Slight concessions if we were to need them, but only on specific units where we've got, like I mentioned earlier, 3 bedrooms. They're a little harder to push right now. So there's that aspect of it. We're really staying on our teams to make sure that they are answering leads and getting back to everyone. So we're secret shopping them, making sure that we're keeping them on their toes, making sure our advertising is in place, and getting those, everyone's fighting for kind of the same traffic. So as long as our marketing is there, the pricing is there, and we're pushing our teams to make sure they're attentive to our prospects, that's kind of the recipe to make sure that vacancy doesn't drop.
Okay, excellent. And then one more question, and this goes to some of our turnovers and rehabs. Based on what we've done since our ownership began last year, what do you think the response has been to some of the rehabs that we're doing on the units?
Sure. It's going over very well. The demographic at Seasons really appreciates that quality, and they've got the ability to pay that bit of lift in rent. So there's only a few very classic units that are getting that the technology package upgrade and things like that. Otherwise, there's very premium upgrades. So it's going over well. It shows well, and all in all, it's been pretty successful.
Excellent. Well, thanks, Michelle. Thanks, everybody, for your participation today. As always, please feel free to reach out to me or Michelle or Carlin with any questions in the future. We appreciate your partnership in Seasons and your confidence in us as we navigate this unique and challenging housing market impacted by the pandemic. This will conclude our Q2 webcast. I look forward to speaking with you again soon. Have a great day.